I want to add a couple things to the Chapter 5 handout. There's a couple of the couple pieces of the evidence that I think we should talk about before we go into Chapter 3. So tonight, Chapter 5 handout, we'll do the multiple choice. And we'll get the answer. We'll see what the group kind of decides for the answers on those. And then sampling overview. And Chapter 3 handout. This might be a little ambitious, but we'll see what we get through. And so once we get through these two, though, that'll pretty much finish it off for Chapter 5. And so then I will send out either tonight or tomorrow a Chapter 5 exam. And you'll have 1 week to do it. You'll have until next class to do it, which is whatever next class is. Give me 1 second. 24th. So the Chapter 5 exam, I'll send that out. I should get it out tonight, but if I don't, it'll definitely be by tomorrow before noon. I'll get that out, the Chapter 5 exam. And it'll be due in by next class, by midnight of next week, I should say. So I'm going to add a couple things onto the Chapter 5 handout. There are things I should have put on there, but I didn't. Let me make sure I got the right one here. Okay. And let me share. So in Chapter 5, I think we ended up with the dual testing on it. And I just want to talk about a couple more topics. One being confirmations, and one being bank documents. Because these are pieces of evidence that you'll definitely get for all audits, pretty much. Okay, so again, these are not on your. So these two, they're not on your handout. But if you would add them, or you can add them as we go along. I don't know. Make them some wild color. Okay, so these are going to be added on.
Which document are you adding this to?
The Chapter 5 handout.
That's one we already turned in, right?
Oh, you probably did. It didn't occur to me.
Evidence handout?
Yeah, the Chapter 5 evidence handout. I've already put a drop on it. If I ever put a drop on it.
Okay, so it ends 13 dual purpose testing. Is that what we got? Dual purpose.
Yeah.
On page 6, and then what we're doing is we're adding 2 more to it. All right.
Yeah. I tell you what. Let's put these on here. I want to put them in. I won't put them on the. You don't need to turn them in. I just want to talk about them. You can write them down somewhere. I encourage you to. But they won't be on the Chapter 5 exam. But but we should talk about them, because we're gonna, when it comes to planning and stuff, this is one of the things you're gonna have as you go through your audit.
Professor, is this from last week's class? Because I was out due to the death in my family, so I just want to make sure.
Yeah. These are things I should have. These aren't in the chapter, but I should have added them into the Chapter 5 evidence chapter. They belong.
Okay.
I just didn't put them in. I should have.
No problem, because I want to make sure I get everything sent in because we had the funeral today. So
Oh my gosh.
it's always, everything's already, yeah, it was a week's time and very quick.
Jeez. That's horrible. Okay, well, confirmations are basically. Well, let me stop this for a second. I can give you that kind of the idea behind it. Let's change cameras. Confirmations are a lot of times. I talked about this in the past. You try to take, the client's data that they generate themselves, the internal data, the internal source, is the worst evidence because they could just print it up, make it up, right? So it's the worst evidence. So what you try to do is you try to take what they give you and move it up, right? And we have that kind of that hierarchy of evidence that you would always try to move it up to the next level. So let me kind of show you what I'm talking about here. And you remember this is from the same hand. This is from the Chapter 5 handout. This is on page 2. This is the best. This is the best stuff. If we can move stuff up. So here you have client data that is very low level. They can just print it out. So you try to move it up. And one way you move it up is, for instance, what we're going to do is take something like an accounts receivable. They have accounts receivable on their books, but we don't know. It could be fictitious. It could be they just could have made it up. So what you try to do is to move things up. So what we do is we call a confirmation. And a confirmation will say, okay, so the client has this accounts receivable on their books, and we're going to take that accounts receivable and confirm it with the customer. Confirm it with the customer that owes it and says, do you owe this amount? The client says you owe them, whatever it is, $600. Do you owe them $600? So that's what we're going to try to do, is confirm this worst evidence and move it up, because then it becomes a third party. Then it becomes the customer saying, yeah, I owe $600 or whatever it is. So that's kind of what we're looking to do with confirmations. We're trying to move it up to better evidence. Confirmations. These are usually done for accounts receivable. Oops, that should be. For accounts receivable, oops. In the U.S. standards, they're required. So U.S. standards are required. International standards, they're optional. So if you are using the U.S. standards, you must do confirmations for accounts receivable. And that's just the rules. So, and if you don't, you are not following the generally accepted auditing standards in the United States. So accounts receivable must be confirmed by U.S. standards. International standards are a little more judgmental. They don't say you don't. In all situations you won't have to use them, but they give you a little more options as far as doing that. So confirmations, they come in a few different forms. And one of them is a positive confirmation. And this is that all the confirmations sent out must be returned. So all confirmations that are sent out must be returned. So if you send out 100 of them, you got to get back 100 of them. You'll get back 86 of them, and then you'll call the people and say, oh, yeah, we'll send you get back up to 94, and then you call them again. Yeah, you get to 98. The last two people you call on the phone, you say, hey, do you have a fax machine? Like, I'm going to fax it over to you, and then you can fax it back to me. I'm going to stand here and wait for it, though. So positive confirmations that all confirmations must be returned. Negative confirmations, if you think about the confirmations, the ones that are okay are really not that interesting. You say, do you owe $600? I say, yeah, I owe $600. Okay. You don't do anything with that. If you think about it, what you're really looking for are the negative ones. Do you owe $600? No, I don't owe $600. I owe $200. I sent stuff back or whatever it is. So negative confirmations, you only return return confirmations if the amount is not correct. So negative confirmations, sorry, I should get it out. Negative confirmations are that only the negative confirmations are returned. Now, there's a problem with the negative ones. What could be a problem with the negative confirmations? You send out a confirmation. You say, only return this if there is a misstatement. What could go wrong?
If somebody didn't get it, you won't know. So they're not acknowledging it. Exactly.
You send it out, it goes to the wrong address. They never got it. Whoever gets it says, what is this? I don't know. It's stupid. Throws it in the garbage. So negative confirmation, it may not have got to the right person. It may have been a fictitious account that doesn't exist in the first place. Maybe a non-existent address even. It could be that someone got it and they just look at it and go, "Oh, they're idiots. I don't, this is all wrong." And throws it in the garbage. To them it's all wrong, but they're not going to waste their time with it. So there's all kinds of things that could happen with negative ones that are that would cause them to be less effective. And so generally, you cannot make any form any opinion based on those that didn't get returned because you don't know why they didn't get returned. So you can only base an opinion on what was returned. So if the things that were returned, evaluating those would be what you'd base your opinion on. Okay, so positive confirmations are better. And negative confirmations aren't as good. So you say, well, why do we even do negative confirmations? Well, it comes down to something like this. Suppose that you wanted positive confirmations. You'd be happy if you sent out 100 of them. The cost each is $20 on average because you're going to spend time hunting those down. Or you'd be equally happy if you sent out negative confirmations. Now, if you send out negative confirmations, this evidence isn't as good. So are you going to have to send out more or less? So the negative confirmations, they're not as good of evidence. So do you need more of them or less of them?
More.
More. So maybe you'd say, okay, I'll send out 500 and I'll be equally happy with either of these. And the cost each is $3. So, these, and you're equally happy with either one of those. Which one would you do? The positive or the negative?
Negative cost less.
Yep. It costs you $2,000 for these, and these will cost some number, $1,500. So it is possible that the negative confirmations are the more economical ones to use. I should have that there. Now, in real life, how these usually work out is the positive confirmations are usually for larger dollar amounts. So if you have accounts receivable that have large dollar amounts, you probably do positive confirmation. And if these have smaller dollar amounts, usually the negative ones are what you end up doing. Oops.
If you're doing an AR test,
Mm-hmm.
and let's say that you're sending out confirmations is over like a 14 to 30 day period, if money's coming in anyways, can you cross that off as if it was a positive confirmation?
Yeah, a lot of times you will find that when you actually do the confirmations, that you send out. So for instance, let's say you send out a positive confirmation, and it comes back and they say, so for instance, on December 31st, you say, okay, on December 31st, did you owe $600? And they send you back the confirmation, and they say, no, this isn't correct. I paid that on January 8th.
Yeah. Because I mean, realistically, if you waited 30 days on even if these were like a net 45 or net 60, you'd have your rollover from everything that had been the prior 30 days or whatever. So I was just wondering, like, if in your sample you collect stuff, comes in from collections, you get to treat that as if it was truthful, right? Yeah. Evidence of a payment is as good as evidence of a confirmation.
And actually, going on to the next thing we're going to cover, the cutoff bank statement is one of those things you can use for that. But it is, if the money is received, well, you got to be a little bit careful with that too, because the money received, it could also be a kiting thing, but where they.
Oh, you're saying if you're taking AR data, it's not as good as if you got third party. So unless you actually saw it hit the bank as a deposit, you wouldn't want to use the client's own, hey, I collected these 10, because it's still like they could be faking the AR.
Yeah, and actually there's a fraud called ZBest, or I think it's 4Z, ZZ Best.
Yeah, it was all fake AR.
Yeah, but what you would do is you'd have this, you'd say that, I build this customer, and then you'd write a check to himself.
That was the contracting one, right? Where he was doing all the like remodels and stuff.
Exactly. And so, you don't get the check back, whoever writes the check is the check back. So he would just write it to himself and say, well, how can you argue with this? The cash is in the bank. What are you talking about? But it was basically him writing the check. So anyway, there's possibilities around there, but sometimes you do get customers that will actually think that they're saying, I don't owe this because I already paid it, but they paid it after the date or whatever, and that's just is really just saying, yeah, I did owe it. I'm telling you, I owed it because I paid it, basically. So yeah, these are always messy. I can tell you that they're just you know, they can just always be. You never know what, dealing with the public. You never know what they're going to do. And you think in business it's all cut and dry. It's not. But anyway, yeah. So you definitely have to look at each one of these and see whether it is actually a problem or not. Sometimes it is a problem. Sometimes it's not. It just just depends. And the AICPA will also tell you that you don't necessarily have to confirm the entire amount in all of the invoices. So maybe you have 5 open invoices with a customer. You can actually send them a confirmation for one of them, because it might be a lot easier for them, and they might be more likely to look it up and to, than if they have to do 5 of them and add it all up and make sure the totals are whatever and that kind of thing. So it is possible also not to do the entire accounts receivable, but to do individual invoices, which a lot of times it goes by what you're more likely to get returned. Yeah, so generally speaking, positive confirmations, large dollar amounts, negative ones, small dollar amounts, so that if people don't send it in, it's usually not material anyways. So if you have big customers, positive confirmations. You have smaller customers, a bunch of smaller customers, more of them. You do negative confirmations is usually the way to go. But again, there is this thing here, though, that you also don't necessarily want to do. The idea that, gee, we should always take the best evidence is not necessarily the case. You might take the second best if you're equally happy with it, but it's cheaper. Okay, here's one that the AIC, it's been on the CPA exam, and that's the blank confirmation. And this requires a customer to write down all of the amounts owed. It would be hard for me to imagine these ever working.
I saw this in a bankruptcy case once. Like, we were sent that for my company, and like we had to fill it out. They said, like, please let us know as of this date what invoices you think you're owed.
Okay, that's you getting in line for whatever.
Yeah.
Yeah.
Old company versus new company, but they wanted us to sort of say, like, they didn't trust the quality of the old AR. Right. Because the old AR was getting rolled into the new company, sort of.
No, was this stuff that you owed or that they owed to you?
They owed to us. So okay. It was a payable to them. It was a receivable to us, but they sent us a confirmation with, like, please tell us what you think. Right. Okay, that makes, yeah. Because essentially forensic auditors were in there trying to sort through bad bookkeeping. Right. Yeah, and that's not uncommon. One thing I tell people is, whenever you are unsure of something, whenever you see something that's a mess, that's where the problem is going to be. When fraud does happen, it isn't usually nice and clean. It isn't like, fraud expense. Here's the documents. It's not like that. The key was they sent us this blank thing, and we're like, well, don't they know what, Yeah, well, yeah. And in bankruptcy, you generally are getting in line with the group of people that are owed money together, and you get paid whatever, 10 cents on the dollar, whatever it is. A lot of times it's to establish what's owed by those people. But yeah, so blank confirmations, according to the AICPA, these are the best. Although I would question whether you get any of them back, or if the information would be reliable. It could be, I guess. But yeah, so blank confirmations are another one. And by the way, this is for accounts receivable. For accounts payable, confirmations are not required. You can do them. But for accounts payable, confirmations are not required. The reason being is there's usually a whole bunch of evidence on
accounts payable. There's receiving reports, there's purchase orders, there's shipping documents, there's bill of lading.
That a vendor invoice already came from a third party because it was on there.
Yeah, there's all kinds of evidence for accounts payable. Now, you will search for unrecorded accounts payable, and there's certain ways to do. Actually, one of the things that I'm going to talk about in a few minutes here, actually, we'll find unrecorded accounts payable. But a couple things, you might look at receiving reports. Anything that was received should have a payable attached to it and that sort of thing. But anyway, there's usually a lot more documents with accounts payable. I'll put it this way. The stuff that's on the books for accounts payable, there's usually a lot of documents that'll back that up. Whereas everything that's generated for accounts receivable is internally generated. Most of the stuff that comes from the accounts payable is going to be third party, except for the receiving report, but pretty much everything else is going to be third party, invoice and shipping documents and all that. So it's pretty good evidence. So anyway, so these are confirmations, and they're a big part of it. Again, for accounts receivable, US requires them for accounts receivable, not for accounts payable, only for accounts receivable. Positive confirmations, big dollars, negative, small dollars. And according to the ICPA, the blank ones are the best. And that's when you send out a blank one and say, write everything you owe us. And depend on the honesty of, of the customer to write down everything that they owe. Okay, so those are confirmations. And again, we're moving from the not very good evidence of an accounts receivable generated by the client. We're taking that accounts receivable and bumping it up into the best evidence coming from a third party, the customer verifying that they are confirming the amounts that they owe. So taking bad evidence basically and making it into good evidence. Okay, bank documents. Now, I'm going to put these on the next page, actually. There are 3 documents that usually come from a bank that are important to the auditor. All 3 of these are sent directly to the auditor. Oops. And that's not how you spell directly. That's how you spell directly. Transposition. So the bank statements, you'll have these sent directly to the auditors. And again, that's taking them out of the client's hands and putting them directly into the auditor's hand. It moves that evidence up. It goes from being medium evidence up to the best evidence. Third party, the bank, sends it, held by the third party, never touched by the client, is the best evidence, the best documentary evidence. Okay, the year-end bank statement. You'll get one of those sent directly to the auditors. Oops. Say 12/31. 2020. So they'll send you a bank statement on 12/31/2020. This will be the exact statement that they send to the client. You can use this to test their bank reconciliation, their amount that they have in cash, and a few other things you can go through there. But the year-end bank statement is sent directly to the auditor. And again, we're moving that up from, the client could hand you the bank statement or give you a copy of it, but you want to get it directly from the bank. A cutoff bank statement. This is one that's only used by the auditors generally, and it's going to be as of, say, partway into the next year. Usually between 7 and 14 days, might be a little more than that, but somewhere around there, you're going to have the cutoff bank statement. And this cutoff bank statement is an important one because it will find it can find a lot of things that are a problem. It can find, basically can find things like kiting and that sort of thing can be found on it. You can find unrecorded liabilities, because if the company made a payment and it hit the books, and it hit the bank, I should say, by the 14th, it was probably owed at year end. Not always, but you certainly want to look into it. So any payments that are made during that period, any checks that clear, you want to look and see that if those are all recorded as liabilities at year end, because it probably is that they should have been. Usually there's a lag between when things are paid and that. So if someone took someone takes a phone bill, instead of recording the phone bill, they stick it in the drawer and lock the drawer and hide the key. And you say, well, how do you find that? Well, a lot of times you can find that through the cutoff bank statement, because they're going to pay the bill, but they just don't want the liability on the books. So cutoff bank statement is an important one, and it comes sent directly to the auditor, and it's usually a week or two into the next year, and you can verify deposits and all kinds of stuff with the cutoff bank statement. But it's an important piece of evidence.
Is that requested with a particular date, or because that's not a normal monthly statement, correct?
Correct. Yeah, it'll have a certain date on it. So it'll say as of whatever the date that the auditors want usually. And it depends, the question is, well, what date do you use? Generally, more financial institutions actually have a very quick turnaround usually in audits and everything else. So
is this a transaction report, or is it like an actual, will it look like a bank statement?
It'll look like a bank statement.
Okay.
Just be a plain old bank statement. It'll have, the receipts and disbursements on it. It's just a plain old bank statement, but done partway through whatever the year end, the next month following the year end. If you have December year end, it'll be January, but it could be, whatever your year end is. And so, the cutoff bank statement will be usually a week or two into the next year, but it's an important one because you can actually catch a lot of stuff. And the AICPA really likes the cutoff bank statement for finding hidden liabilities. Excuse me. So that one, this is kind of the main reason why they do it. You're looking for unrecorded liabilities, and they really, I say it this way, in the past they've really hit that hard. Okay, bank confirmation. This is not like the other kind of confirmation. This is a confirmation of the bank's. It's a standardized confirmation, and it'll basically have all banking activities. Oops. Let me change this. For example, it'll have all accounts. Savings accounts, checking accounts. It could be other accounts, could be clearing accounts. So you can have any number of all the accounts listed. It will usually have also all of the other information. Loans. And usually for the loans, they'll have the agreements, the basic parts of the agreements usually. So interest rates, payments, all that kind of stuff. Now, here's the thing about when I say all the accounts, these are not actually a bank statement. So these will only have the ending balances. You're not going to see all the transactions in these. So when they verify the accounts, all the accounts, they're only looking at they're only verifying the ending balances. So the confirmation is only for the ending balance. They say the 1231, this is what was in those accounts. If you want to know how they got there, you got to look through the bank statements. But they'll only have the ending balances on here. The big one so the one that is usually the most useful is that the loan agreements will be in there. What kind of collateral do they have to have for the loan agreements and all that kind of stuff. And that's very important for auditors, because if there's a loan agreement that says they have to have a certain amount in, say, inventory, when you do the audit, you have to pay attention to that, because the bank is probably going to rely on that to see if they're in compliance with the loan agreement. And if they're not in compliance, it might be that the loan is due immediately. So one of the reasons why you look through those is to know what to audit, too. It's evaluating a risk, basically, that if they're not in compliance with the loan agreement, that could be a problem. So as you go through these, each of these is good for their own purpose, but these are 3 of the documents you're going to get from the banks that are evidence, and they're good evidence because it's coming directly from a third party. Any questions on that thing? Okay. I tell you what, let's take out the multiple choice questions. Let's save this. I gotta stop sharing. I hate sharing. Okay.
Professor, can you give us the story of these guitars?
The stupid guitars? Yeah, the stupid guitar. The reason why the guitars are 3 feet off the ground is I've lived in this house for 20 years, and last year this basement flooded badly, and the guitars were caught in the flood. You can't see them.
Do you play? That's what I was interested.
I used to play some. I haven't played in a while, and there's another dozen of them on the other side of the basement. But this is my basement. So anyway, but they flooded. So the new thing is everything has to be up off the ground. But never had it flood. I had to get a little water coming before, but it was bad. It was it was a foot or more of water. And so I go, oh, okay, well, maybe the sump pump broke or whatever, So I put a second sump pump in. I go out to drain it outside. I look out in our street, it looks like a river. It's like those things you see on TV where the people are, some devastated place. Like you could have canoed to City Hall down our street. We couldn't believe it. So anyway, at that point, I thought the whole basement was going to flood to the ceiling, but anyway, that's why the guitars are off the ground, and I haven't tested most of them to see if they're even working. so those
a little rust on the pickups, a lot of different sound tone.
yeah, just a little, so some of them might be guitars, and some of them may not be, but some of them might be just nice wall hangings that I can put up somewhere. All right, but yeah, that's why they're up off the ground. I'm in my basement. It's a usual basement. Okay. All right, so let's go to, so this is a handout from last week. We had the multiple choice questions. And let me pull that up. And I think we could probably do this. If you guys looked over this, you guys could probably we could do it in the chat if you want. You want to put your answers to it, but or you can even just say it. I guess either way. But I think what we thought we'd do is go through and just talk about these. Some of these are actual CPA questions from the CPA exam, and you know, there are real questions from the CPA exam. There's a lot of really of actual evidence questions because evidence hasn't changed 25 years or whatever. But the real rules though for the CPA exam are that you pick the best answer. So it isn't the only answer a lot of times, it's the best answer. All right, so the first one, what did you guys get? Which following element ultimately determines the amount of audit work that's necessary?
A.
Yep.
Did you want us to put these in the chat or it doesn't matter?
Yeah, why don't we? Why don't we put them in the chat? That way kind of everybody will get a chance to throw stuff in. So, and by the way, the polling thing, it's a lot more cumbersome than I thought, but I'm going to try to get in a standardized one. So it'll just be, in the future, it'll just be question 1, A, B, C, D, question 2, A, B, C, whatever. And then everyone can just go through the polling and click on it. So don't have that yet, but hey, it took out my chat. What happened here?
Do you want us to send the answer just to you or to everyone? What do you want to do?
It's up to you. You can send it just to me if you want. That's fine.
Okay.
Yeah, because if some people send it private to me,
Property here.
there's only 5 people, so you kind of okay. You see, 3 people answer. Well, I know what the 4th person did because this is weird. It's not showing my. How come it's not showing the chat? Oh, here it is. Okay. Okay, so question number 2. Let me figure where I'm at. Question number 2. Testing plant equipment balances. The auditor may physically inspect new additions listed on the summary. Physically inspect new additions. Okay. So we're going to plan equipment and transactions for the year. This procedure is designed to obtain evidence concerning assertion about classes of transaction events and specifically which assertion. Let me see my. It's not showing my chat. Oh. Anyone else? Question 2. No one else is here. Oh, here we go. Okay, let me ask this. Do you guys want do you guys want to take a break and go through those? Just go through them for yourself, take a look at them, and then we can come back at like 10 minutes or whatever. Because I know I said you can look them over, but I don't think I asked you guys to put them in. So. I can't remember. Did I assign this? I can't remember, to be honest with you. Okay.
I don't think you assigned this. I don't remember you assigning this. I remember you assigning the questions, the chapter questions.
Yeah, I think I said we go over them.
I remember you saying we would go through it together and you thought you were going to turn on the polling feature. So I recall you saying we should be ready to do it. So.
Right.
But that we didn't have to turn them in yet.
Yeah. Okay. Well, I tell you what, it's a little bit early, but we can go ahead and take a break. We can take like I'll tell you what, we can come back at like, we can make it like 7. How about? I'll give people a chance to kind of look at it, and I don't think I told you guys to do it ahead of time. I probably should have, but so I'll give you guys a chance to kind of take a look at them and kind of go through, and we'll kind of it's kind of fun to see the different answers, because these are tough. They can be, and it's good kind of do it in a group, and that you can actually get a feel for kind of how the questions are, how the kind of the construction of the questions. And I'll tell you something else that you'll notice too. And when I go through the solutions of these, I'll see which ones are the actual AICPA questions. Although I'm not sure if they actually list them as that. But anyway, the you can really tell ones that are actual CPA questions from ones that aren't, because the real CPA questions are really vetted. I mean, they're they got a lot. And I keep losing my. There we go. Okay, so yeah, so we'll go ahead and when we say come back, be back at like 7. Just knocked over my camera. Okay, so be back at 7 p.m. and then, like I say, we'll go over them, just kind of give it's good to go through and to think about them, because that's really where you're going to learn them. Okay. I'll stop sharing for a second, because I want to get rid of this stupid shadow thing that keeps popping up. would I get this thing to quit appearing and disappearing on my screen? It's like a ghost that keeps coming back.
Is it in Word?
I don't know. I don't think so. I
Just window away from the shared application.
because I think that it might be one of the from the drop downs from the Zoom menu. I think it's the drop down from the Zoom menu. Let me do this. Let's see if it goes away if I change cameras. No, it's the exact size of the Zoom drop down. I'll figure it out. It's irritating. I mean, it doesn't really affect too much, but it's just. I know. I'm going to stop this for a second, then I'll. Try something else, and then I'll go back to it and see if it stops. It's one of the things just annoying. It's not really. Okay. So let's go to number 2. Which one of these is it most likely testing? But there actually are 2 that it could be generally, but which is the best answer? And if you want to answer in chat, go ahead.
I think it's a cutoff.
It's actually between the occurrence and cutoff. The occurrence is probably the most important one. Where am I at here? Oops, I did that wrong. And that the transaction actually happened, and you probably also look at the date in which it happened. Now, cutoff is the next one that it could be. These other 2 are probably not, don't have anything to do with it. But cutoff, it could also be it could be the same thing. That it could be seeing if it is in the correct period. The thing about the cutoff, though, is for a lot of times for property, plant, and equipment, it's not as important as, say, inventory, because if it's at year end, it's not going to affect the income statement. It'll affect the balance sheet, but it's not going to affect the income statement. For instance, if you bought a piece of equipment on December 27th, okay, you round depreciation off to the nearest month, it'd be 0 depreciation. It wouldn't matter whether for the income statement, it wouldn't matter that you didn't put that on the books. It mattered from the balance sheet, but not from the income statement. So probably the best one there is the occurrence that it happened and when it happened, because then you would know what the depreciation would be for those pieces of equipment. Existence would be another one a good one that it would test. Does it actually exist? But probably the best answer there's going to be the occurrence. Okay, footing. As an example, we didn't talk about footing, so I think I'm going to kind of show you what footing is, and that's this thing I had. Footing is simply, oops, let me do it. If you have a client that gives you this data, and what you would do is you would foot these. Different companies have different ways of showing footing, but you usually have something that looks like that for footing them. And when you get to one like this that foots the, going across and down, you'll usually see this listed as the tick mark would be cross foot. So a lot of times these are what you'll see for the different tick marks for each of them. But what you basically do is add each of those up. And I always talked about how they used to do it with adding tape. And one of the people in class I had said, yeah, they still do it. He said their auditors came in, they still use the adding tape. So if you gave them something, even if it was electronic, they would use the adding machine and put the adding machine in, the adding tape and the printout into the work papers. So this is what footing is. It's when you verify that what they have is actually what they should have for that column. So that's what footing is. And if it's going two different ways, be cross-footing.
Professor, I did a project one time where we were taking inventory in a warehouse where the warehouse manager had been told to leave old numbers on his sheet. So he would keep track of the individual counts in pencil, but his final totals never moved. And we did this, like what you're seeing right now, and went, your numbers don't add up. And he said, I was told years ago to always leave these numbers alone, and I just use these other ones for myself.
Yeah, that's an example of.
I went to close a warehouse and went, "Where's all the inventory?" It was not there.
Well, another thing is that about internal controls is how they're actually used. It can be either it's not understood, or whatever, or they're told incorrectly or whatever. Okay, so footing is an example of
recalculation.
Yep, it's recalculation. It is when I do that wrong every single time. I think it's still wrong. Yeah, you're recalculating their numbers. And it wouldn't be any of those other ones.
But wouldn't the recalculation also be confirming?
Well, confirmation is kind of like we talked about, in the other handout. Confirmations are usually when you send it to someone outside of it. So for instance, getting accounts receivable.
Receivable. Okay. All right. I remember. Yeah. Okay.
Yeah, and inquiries are asking people, questions. Analytical procedures are when you're looking for relationships in the numbers. So yeah, I mean, and again, it's not saying that there was only one answer on these, but again, the definition of or what they tell you to do on the CPA exam is pick the best one. So and again, that is it's a judgment call, right? Okay, 4. Determine whether transactions have been recorded. The direction of audit testing should start from the So see if a transaction has been recorded. And you can either shout it out or put it in chat, however you want to do it.
How about C, original source document?
That is exactly right. Perfect. Yeah, if you want to see if it's been recorded, all transactions have been recorded, you'll start with the original source documents and trace them through and see if they actually show up in the financial statements. And notice that if you go the other direction, so for instance, let's say you go from the general ledger and go back, that doesn't tell you that the transactions that haven't been recorded. They'll show you the transactions that are included in there, but it won't show you the transactions that have not been included in there. There might be additional ones that aren't. So if they have, say, for instance, 96 transactions listed, there might be 100 transactions. If you trace them back from the general ledger, you're going to find all 96, but you're going to miss those 4. Whereas this, if you trace them forward, you can find the 4 that aren't included. Okay. To test for unsupported entries in the ledger, the direction of audit testing should start from the. So there's something in the ledger that won't be supported. In other words, it didn't happen. It's a fraudulent entry.
Start with the ledger and work back. It's like vouching.
Yep. Yeah, if they're unsupported, so every number, every amount in the ledger should be supported, right? So if you're going to find one that's not, you go from the ledger, work backwards, and say, okay, let's see. They said that this is 900,000. Let's go see how that they came up with that number and start tracing it backwards. And if it's not supported, again, it could be that it's a fraudulent entry or an error. It could be a number of things, but okay. So unsupported in ledger, you're going to go from the ledger backwards. Of the following, which is the least reliable type of audit evidence?
Is C, ask the controller about an end or period adjustment.
Yep, that's it. Yeah, and you'll notice that if you look, at all of these, which one is the best? Documents mailed by outsiders to the audit, so that's third party. Good evidence, right? Third party good evidence. Correspondence by auditor with third party vendors. Okay, so again, writing to third parties, this is directly going right to the audit. These are like the best evidence.
That's a confirmation, right?
Yeah. Yep. Yeah, this would be a accounts payable confirmation for this one. This one could actually be accounts payable or accounts receivable confirmation. And computations made by the auditor, the work that you do yourself generally is more reliable. It's more reliable than evidence you get secondhand, which is what this is. Asking your controller about end of the year adjustments. I got a put this up here. I had a friend who did an audit who so he went in. He had a bunch of a questionnaire and then some other questions they asked. I think it was the assistant controller. And he came in and he said, okay, well, your accounts receivable went up by 10%. And, why did that happen? And the controller says, well, there's 3 reasons for that. We did this and we did that. And he just rattled off these 3 reasons for it. And my friend's looking at it, he realized he said it backwards. He said, oh, wait, they didn't go down by 10%. They went up by 10%. You know what? He said they went up by 10%. And the controller says, well, there's 3 reasons for that. Just rattled off 3 more reasons. The point being is that, the information you get from that is not that great of information. It might be that they're just trying, hey, what do I have to say to get rid of the auditor? All right. Audit documentation is a principal record of the audit. It provides the principal support for the auditor's report. Because of this, the audit documentation should do all of the following except for
Is B?
Yeah. Yep.
These are the kind of questions where you have to read every answer and go, that could work, that could work, that could work. This one doesn't sound like it's relevant.
Yeah, and this one is support for human resource department's employee retention decision. You do not generally put any comments on somebody's work in the work papers.
So like even if a bookkeeper was terrible or someone in treasury.
Well, no. I mean, like this is for the audit firm. So for instance, okay. if
oh, got it.
Yeah. Your job in the audit is, and if someone did subpar work, well, you got to get somebody else in there or have that person do it again or whatever. You have to have enough documentation, but that's the only thing you have in there. You have documentation. You don't have, gee, Fred is not very good at this, or Fred's great at this, or whatever. That's not, that comes in a different kind of quality control decision. So you don't put, human resource, basically, stuff related to your firm in the client's work papers. Okay. Audit documentation prepared on audits of public entities is the property of?
B, I just realized my computer was on mute, so I'm yelling out the answer and you don't hear me.
I should unmute people, but then you get people like if you unmuted me at times, you hear like my dog. I think I told you guys I have a dog that just is just nuts, and you'll hear it sometimes running around upstairs. So if I mute sometimes, it's kind of what I do. All right. Yeah. So the documentation is the property of the auditors. It's confidential. You can't just post it on the internet, but it belongs to the auditors, and it's basically your evidence of what kind of an audit you did, how you came up with your conclusions, and materiality and all that kind of stuff. Okay, 9, you're auditing a store that sells merchandise. Some of the store merchandise is held on consignment. Okay, so consignment is when someone brings something else in. So it's not actually owned by wherever it's at. Which account balance assertion for inventory would be most concerned to verify?
And the rights and the obligation, you say?
Yep. Perfect. Yeah, do they actually own it? So if you're looking at a bunch of inventory, the question is it yours? Do you own it? I was doing an audit of iron ore place up in Minnesota, and they had these huge conveyor belts that run for miles, and they had these huge conveyor belts sitting in the place. And so I'm walking around, I see these things all over there, and I'm looking, I can't find them in the. Threw something on the floor, and as I'm looking, I can't find them anywhere in in inventory, and nothing in assets, nothing in, and so I'm going through and I'm talking to people that no one knows. Anyway, I came across they're actually on consignment. The company that sells those conveyor belts, they don't want to hold on to them, so they go and they drop them off at the plant. The plant likes it because whenever they need a belt, it's there, and the vendor will come in, count how many belts were taken, and that's how they do the billing. So even though we had tons of these belts, and they're expensive belts, but we didn't own any of them. Okay. You're auditing a manufacturing company that has a large production facility. Some of the production equipment is held through lease agreements. Which of the following account balance assertion would you be most concerned about?
The rights and obligations again?
Yeah. Because you may actually be owning those.
Well, it's sort of like whether or not the liability is properly showing on your balance sheet, like whether it was an operating lease or a capital lease at some point, like you may have depending on exactly what it is, there might be a treatment where you might have to have the asset right on your balance sheet with the liability.
Yeah. Yep. And actually starting this year is getting so that pretty much anything that's over a year, they have to put on the books.
Okay. Because there used to be these dollar buyout leases where you were like, it would like convert, and like, I don't know in GAAP world what it was, but for private companies, it looked like you could expense something off, and then at the end you owned, take your pick, your solar system, your lighting, your HVAC,
Yeah, they had the 4 criteria: that does title pass, is it a bargain purchase, 75% life rule, and 90% fair value rule. And I'll tell you something a little bit funny is that I had a a guy that I went to school with, and he worked for his brother's CPA firm when he graduated. The first CPA firm, I only had like 5 or 6 people. Their sole business was going around the country structuring contracts so that companies didn't have to put assets on their books. So that's why you have
They're a tax opinion company. Like, if you do it this way, we'll give you an opinion that says it's, well, I mean, all of real estate works this way for, like, think of all the Dunkin' Donuts and all these, you know, custom built properties that are, you know, what are they called?
build outs or something.
Lease build outs or whatever it's called. But
Yeah, but literally, they'll, like, you know, an airline will buy 50 airplanes and immediately turn around and sell them and lease them back. And so you would go, they would go around and structure those deals so that the company wouldn't have to so the company wouldn't have to put any airplanes on the books. The companies don't want the airplanes on the books, but they also don't want the liability on the books. So they would try to keep both those off the books. And that was part of the, you know,
be like a sale lease back. So what it is like they would go develop a property, you know, build, you know, buy the asset, and then they find someone to spin it off to, so they get it off their books once they have it like the way they want it.
Yeah. And they would just structure all these agreements. You know, it's funny because it's literally like, you know, that one accounting rule probably accounted for 90% of their revenue. I don't know what they're doing now because the rules all changed. But anyway, yeah. Which of the following procedures would an auditor most likely perform to verify management's assertion of completeness?
A.
Yep. Yeah, look at the shipping documents and see if they actually have sales invoices for all of them. And you might do that, especially if the company, you know, if you suspect they might be trying to reduce their sales, right? So they pay less taxes, so it looks like they're not profitable and all that kind of stuff. So you might look at the shipping documents and say, okay, well, you shipped all these things. Where's the sales invoices for them? We hit them, you know, or whatever. Each of the following might, by itself, form a valid basis for an auditor to reduce substantive testing, except for the, okay, so reducing substantive testing. This is generally when you feel more confident about, you know, the client. So which one of these might reduce the amount of testing, or more importantly, which one doesn't?
Is A.
Yep. Yeah, if the control risk is low, that means that there's, you know, lower risk is better. So if it's lower risk, you can say, okay, I don't need as much evidence because it's low risk. Low inherent risk means whatever the item is low inherent risk that anything's going to happen to it. For example, you know, theft of a large piece of equipment from a factory, you know, a robot on an assembly line of an auto plant. You know, who's going to take one of those and what would they do? You know, how would they do it in a low inherent risk? And if the evidence is of very high quality, again, you can take less evidence. This one is an important one because you cannot keep from doing a test simply because it's expensive. You know, oh gee, it's expensive to do that. Let's not do that. We won't get that evidence. So even though it might be expensive, if you run into a situation where you need that evidence, that is, you just have to go ahead and pay it, you know, to do the evidence. So one of the things is, you know, while we do look for the most economical way to do it, if there's certain evidence you need and it's expensive to get it, you just have to get it.
So as an example, like if they have a warehouse in a far off region, you know, they put it in the middle of the desert somewhere and someone needs to go count what's in that warehouse. You can't just rely on the third party because you're like, well, it takes 3 flights and a day to get there.
Yeah, it could be. I mean, yeah, there definitely could be situations like that where, you know, a lot of times if they're in different locations, sometimes you can get other auditors to do it. But it could be, you could be right, you know, maybe they have something in, you know, that is being stored somewhere that is inaccessible. Maybe it's inaccessible for a reason because, you know, it's, you know.
All those airplanes are being furloughed in the desert somewhere in the Mojave.
Yeah, go count airplanes. Yeah. All right. Yeah. So just because it's expensive doesn't mean that you're off the hook. Like, well, it's expensive. Well, that doesn't mean you don't have to get the evidence. All right. Which of the following types of audit evidence is most persuasive? By the way, auditee, I don't know where, this is a kind of kooky question. This is the client. They're talking about this is the, I don't know, I've never seen that term before, but this is the client. I should probably change that.
C.
A. Pre-numbered internal.
Here's what I think about it. Think about where these documents originate. Are they internal or external?
External.
Well, it depends on which one. So let's see. So the pre-numbered internal purchase order forms. Is that an internal or external?
That would be internal.
Internal. Auditee, by the way, auditee is the client. This is not the auditors. This is I doubt that's a CPA question, but I guess it could be.
I would think C, the bank statements.
Yep. This is an external document. Now, it's held by the client, but it's still an external document. Whereas all the rest of these are something that comes right from the client. Well, the client, this last one here, the client's telling you the responses. This is coming from the client. This is not an external source. So these A, B, and D are all internal source. This one's external source. It's not absolutely the best. You'd rather have the bank statement come directly to you, but it's up one level from the other ones. Hey, wait a minute. It's supposed to be Yeller. Okay. Audit documents record the results of the auditor's evidence gathering procedures. Audit documents record the results. Okay. When preparing audit documents, the auditor should remember that so what do they use the audit documents for?
How about B?
B is a tempting one, but it's generally not going to be the primary support for the financial statements. And you know, if you think about it, the financial statements, the client's documents should support that. Should support the financial statements.
See?
Nope. We can't say, okay, you know, we're not going to use your records. We're going to use our records, and you can use these for your financial statement.
I'm going with
Would it be D?
It is, yep, D. So they should design to facilitate review and supervision. Work done by spacing. I should have bolded it. There we go. So you should be able to review and supervise the work done by signing it. So everything in the work paper should be able to be reviewed and verified, and basically, any testing and that sort of thing should be repeatable. The conclusion might not be the same, but the results should be the same and all that kind of stuff. So they should be designed so that someone can review and use those to supervise the work to be done. And the AICPA is really big on this, that they, especially the supervision thing, you always have to supervise everyone on the audit. You can't just assume that they did it correctly. And again, if you're starting out as an auditor or an associate, it's not uncommon to have 5 people review your stuff. Okay, excuse me. Based on conversations with the owner or manager of an audit client, the auditor ascertained that the company's primary motivation is to avoid income taxes. Okay. Based on this motivation, which account balance assertion for ending inventory will the auditor most likely be concerned about verifying?
B.
Yeah.
A.
Now this is the ending. Actually, this one's a little bit more complex than it first looks. The ending inventory will be auditor be concerned. So the motivation is to avoid paying income taxes. So you pay income taxes on income, right? So
Your cost of goods sold goes up and down depending on what your inventory is.
exactly. A lower ending inventory means a higher cost of goods sold, which means a lower income. So it would be to their advantage to not count all the ending inventory. Because that would cause their cost of goods sold to go up. It's like
So if you omitted a whole warehouse or half the building or something, it would be as if you consumed it, right? Like you're.
Yeah. So for instance, if you have your beginning inventory, your purchases, let's give you available. So let's say you had this situation. Your beginning inventory was, I was making these numbers up, 100. Your purchases were, say 800. So this would be the total. These would be the available. Okay, and then your ending inventory. Which is not spelled that way. So you have an available. So your ending inventory, let's say, is you subtract out your ending inventory. Let's say that they have it should be 150. Let's say. So this would be your cost of goods sold. Would be 900 minus the 150. And so if you had sales 1,000, oops. Okay, so it goes into your, this determines your cost of goods sold. So let's say, okay, I don't want to pay taxes. So what I'm going to do is this, I'm going to knock out all my inventory. I'm going to say I only found 60 of inventory. In those accounts, cost of goods sold jumps up, gross margin drops down. That's exactly what, if you're avoiding taxes, that's what you want it to do. So that's why that one is, I can't remember now. What do you think? Completeness, right?
Yeah. Because it would be like if you omitted some of your inventory. It's a little confusing because existence sort of sounds right, but I think it's completeness.
Yeah, yeah. If they overstated their ending inventory, they'd actually be paying more in taxes. So so this is actually the key here. And by the way, this is, this is something that is that is usually a problem of companies that are privately held more than publicly held. Publicly held companies, people like to see lots of profits and they'll do crazy stuff to make profits. A lot of times privately held companies, they don't want to pay taxes. And so they'll do things to avoid paying taxes. And, whatever it is. So you kind of have, a lot of times you'll have a different motivation for privately held companies than for publicly held companies. Okay, you're concerned with unrecorded transactions in the purchasing cycle. Okay, so they purchase something they didn't record. Which audit procedure are you most likely to use when auditing purchases?
Is it B, tracing vendor invoices?
Yeah. Yeah, that's probably going to be the one. Yeah, this is the best.
You would match up your invoices to your purchase orders and make sure that everything is in your system.
Exactly, and you're looking for things that are unrecorded.
So it could look like open POs would be like, did you receive that? Like if you received in the inventory, but you didn't actually mark it in your system, you wouldn't show the liability, but you could show the inventory, and it's a way to manipulate.
Yeah, definitely. You don't record the liability, and the inventory magically appears. Yeah, and you say, well, with this one, you're watching some of the accounting records. Well, the accounting records are only going to show you the ones that were recorded. So if you're looking for ones that are unrecorded, you can't use the accounting record. You can't go from the accounting record back to the invoices. You go from the invoices to the accounting records. And this one is just the calculating vendor's invoice. There are tests for that, but it's not. It's not going to be unrecorded transaction. And it says confirmation of customer accounts. These are customer accounts, not vendor accounts. If it's purchasing, it'll be a vendor. So if this said confirmation of vendor accounts or of accounts payable, that would not be a bad way to test it. You could say, you could send it to the vendor and say, they buy this amount. They say, no, they bought more than that. They bought, So that would be another way of doing it. If the company had somehow hidden the invoices, or where you didn't have access to the invoices, you send a confirmation of accounts payable. But again, a lot of times too, there's other ways to do it too. You can look at receiving reports, check receiving reports to see if they show up in the records and all that. So there are other ways to figure it out. Okay, so anyway, those are our CPA questions, and I'm going to definitely try to get the polling thing ready for next time. And I'm going to see if I can make a generic one that we can just put in like 20, and it would just say question 1, question 2, question 3, whatever. Everyone could fill in the answers, and it's but anyway, going through it like this, a lot of times you get a lot out of it. Okay, so I'm going to make an accounting. I'm going to make a exam. So the Chapter 5 exam. I might throw some CPA, some of these questions on. It'll be similar to these. Probably won't be exactly these, but they'll be similar to them. And you can work through those. And there won't be too many. There'll probably be 3 or 4 of these, and there'll probably be 3 or 4 essay questions, and that'll be it. So, any questions on that? So I'll send out the Chapter 5 exam. It'll either be tonight or tomorrow morning, and it won't be due until next week. Okay. Well, lastly, I want to get started. just through sheer determination, I want to get the start on the sampling overview one. I don't think we did anything with it, did we?
Just printed it out and carried it from week to week.
Yeah. Actually, I got it printed out too.
That's not a slam.
No, it's just an honest statement. That's all. Okay. Well, I think let's go to the sampling overview. We'll start going through these. And the first one is selecting as a sample. You get a second to get this up. And the idea of it is take a sample and project the findings over the whole population, whatever it is. So you take a few items and then project it over many items. The thing that's out in everybody's mind nowadays is COVID, vaccination. You know, they test on a certain number of people. They find out what goes right and wrong with all those people, and then they project it. Okay, then we can project it over the entire population of the world and say, okay, you know, this is how this kind of affects people. And you know, so and sometimes you do a sample because it's more efficient, and sometimes you do it because it's the only way to do it. You know, you cannot take every person on the planet and give them the virus test, the vaccine test. You know, so you have to take a sample and then project it over. Okay, so how do you pick the sample? Random sample. A random sample means what? Pick something randomly.
Use a random number generator.
Yeah, you could.
So number all your line items and use a Excel function and.
Yeah, it could be the Excel function. You could use random generator. You could use random number tables to pick it.
Roll dice.
I used to have students in the advanced auditing classes do spreadsheets on them to make, to give all the items within a range. It ended up taking a lot longer than it was worth. And some worked better than others, but the idea is exactly the same. So using a random number generator, I'll tell you a funny one. I ran a random number generator. This is years ago. The computers were old and lousy. And I ran a random number generator, and I'm looking at the sheet that I had from the previous year. The numbers were exactly the same because they had the same start. They were random, but they had the same start number, and they all were the same. And so I had to copy it and put it to a different, to make it give me different numbers. And later on, you can just press the F9 key. But it's funny because it generated the exact same random number because it goes by a starting point. And it's like, what a coincidence. The exact same ones that are picked as last year's. So random number generator in Excel, random number tables can also be used. The reason why we want a random sample is why. Why do we want a random sample? You remember from your auditing or your statistics classes? Random sample it is the best way to do it because it is what? Why do we care if it's random or not? We like it to be random because it's unbiased. So a random sample is usually what you'd want to get. It's the best because it is unbiased. that it will give you the best it's most likely going to give you the most likely representation of your sample matching up with the total population. Okay, the next best would be systematic selection. So we'll say this is the, oops, let's take that off. This will be the second best. Hey. It's fun watching me learn how to use a computer. It just never gets old. And this is the second best. And this is when you pick every nth item. So for example, oops. Pick every 10th invoice for testing. And the problem you have with systematic selection is that it might not be random, in that you may have something that occurs, say every 10th item, that you're missing or that you're hitting on it every 10th item and more likely to hit on it every 10th item. For instance, if they have some way of that it starts over at the 10th item or something, you run into the problem that it is generally not as good as a random testing. It's an easier sample to pick. Usually, just go every 10th item. You don't have to worry about, go to the 15th item, go to the 198th item, go to the 123rd item or whatever it is. And it's usually, I would say it's the second best. Though the problem you might have is that there might be something that reoccurs every certain number of items that might be underrepresented or overrepresented by your whatever the interval is you're taking. So random sample is the best. Systematic section is the second best. Haphazard selection is not very good. And that is when the auditor picks a sample by chance. And that you just reach in, there's a file, you reach in, you pull out 10 file folders. I actually did this one time. So haphazard selection is the worst. And it's bad for coming down here. It's bad for auditing for a couple of reasons. First of all, it may very well not be unbiased. If you're picking out envelopes from a drawer, say, folders from a drawer, some folders sticking up might be more likely to be picked than one that's not. Thick ones might be more likely to be picked than thin ones and all that kind of stuff. But also, it can't be repeated. If you take these first two, if you use a random number generator, it shows random numbers, you get that printout, or you copy that to just the numbers. Anyone can pick those same numbers that you picked and get it. Right? Same with this one. Every 10th invoice, okay, you started with invoice number 7, every 10th one, so you get 7, 17, 27, 37, whatever. This one, you can't pick the sample, because if I close my eyes and pick the stuff out of the drawer, and you close your eyes and pick stuff out of the drawer, you're probably going to pick different ones. So part of the problem is that it's generally is not repeatable. And possibly the worst one is block selection. And this is when a for example, where we pick a sample of, say, all October sales. So we're going to take all October sales, and we're going to use those to base it on our, our audit on the sales for the year. So the only month we're going to take is October. We're going to take all of October and verify those sales, and that's it. The problems with that are probably obvious. Well, first of all, it's repeatable. Yeah, anyone can go and take all of October sales. So in that way, it's somewhat good, but it definitely falls down that it may very well be biased. And that, it's not going to tell you what happened in December. It's not going to happen, that, and anything that happened in any other month, there might be a problem. It's not going to find it. There's no chance of finding. There's no chance of finding anything that could be wrong in December. And things in December are more likely to be wrong if there's a problem with it. All right, I'm going to tell you a boring auditing story about the haphazard selection. I was working at U.S. Steel, and they have huge buildings at U.S. Steel. This is in Gary, Indiana, and because they used to have armies of people doing invoices and selling steel and all that kind of stuff, iron ore coming in, and armies of people doing it before adding machines and all that kind of stuff. So, when I was there in the early '90s, there was tons of office. You could get office space in anything you wanted. I mean, these places, some of these rooms you could play football in. I mean, they were just huge. And so I was doing an audit of invoicing of secondary steel, which is it's a different market, whatever, of steel. So anyway, I go in there, and huge place, just massive, and everybody's in this one. Pretty much everyone's in this one area. This one, kind of big windows, whatever. So everyone's in this one space. Going through, and I'm going through the audit, and everything's going okay. And then I have to do these ones that were these irregular invoicing things that were for. They could be almost for anything. They were very. You could have ends of steel. You could have all kinds of returns. It could be really high end stuff. It could be really low end stuff. And all. Anyway, it was just all this kind of miscellaneous kind of billings. And I said, well, so I'm trying to find where to do that. And they go, oh, well, you gotta, that's down the hall. You gotta go down the hall. So I go down the hall. Big place. I mean, we're talking about hundreds of people. You're going down the hall, and I can hear people talking. And I go into the room, and there's a woman there by herself who is quite obviously an untreated schizophrenic. She's talking to herself. I say hi, and she just kind of looks at me and doesn't say much. And, then she starts talking. I don't know if she's talking to me. I'm sorry, what did you say? Couldn't, I couldn't communicate with her. And it really freaked me out quite a bit. And so okay, well, I just got to do this audit. So I got to, I picked a sample.
So I got the sample, random sample, and there's boxes everywhere, and I can't find any of the things that are in my, they're not, they're not numeric. They're not. I'm trying to, and I'm asking her questions, and she just kind of looks at me, doesn't say anything, or something, or she says something completely unrelated. It's whatever it is. And so I don't know what to do. So so I go back to the other. I say, what's going on? Why is what? And apparently she was an untreated. She used a schizophrenic, and she had medication, but she didn't want to take it. And it was a union thing. They couldn't make her take her medication. So she just, she wanted to be down there, and the rest of the office was fine with her being down. So she just wanted to be by herself. I guess she was going to retire in about a year or something like that. So they were going to let her just work down there. So I go and talk to my supervisor. Of course, my supervisor is this old school, auditor. Well, yeah, you have to get the sample. We have to get the sample. Like, okay, well, tell me what to do. How do I do it? I can't talk to her. I don't know. I can't figure out what if you want to come down with me and look at these spots, there's boxes of this, of these, these invoices. I said, I can't make heads or tail of where to find these. Well, that's an audit point. Well, okay, it's an audit point, but what am I going to do? So anyway, we came up with, well, okay, pick a haphazard sample. If you can't distinguish how these are being sorted, you're probably going to be unbiased in what you pick out, because you can't find rhyme or reason of it anyways. So I picked out these. The sample came out of, I picked a haphazard sample out of these boxes. It looked like there was about 10 boxes that she was actively working in. And I'd go over to one of the boxes and I'd say, well, what's in this box? So anyway, I picked the haphazard, and here's the kind of punchline to it was that these were perfect. Everyone I tested was absolutely perfect. There wasn't a problem at all with any of them that I tested. And I had a big test. It was like 80 of them or something, which is fairly large, and none of them had a problem. And that's the thing. One thing about that now I know about schizophrenia that I didn't know back then was that schizophrenics are generally very highly intelligent people. It's one of those. This is more likely that someone is schizophrenic if they're highly intelligent, more likely to get it. And she was absolutely competent in her job, which you wouldn't think by talking to her or trying to talk to her. So anyway, that was the only time in my life I ever did a haphazard sample, and it was really kind of great. I felt horrible. I can tell you that I felt horrible for a long time. Like, someone should go help her. Why doesn't someone help her? And all, So anyway, I hope that when she retired that she got back on her medication or whatever it was. But anyway, that's my weird haphazard sample story. All right. So I'll be sending out an exam later on today and tonight, either tonight or tomorrow morning. And again, you'll have till next class to turn it in. So you'll have at least 6 days to turn it in. And it'll be just on chapter 5. It won't be on anything else. So hold on to this document, the sampling overview, and we will pick it up next week. And next week we'll start in on chapter 3, like the chapter 3 handout that I sent out. All right. Any questions? No. If I put you to sleep, I'll be quiet. All right. I'll talk to you guys next week.
See you next week, Professor.
Okay.
I have a question.
You have a question? Yeah.
Last time we talked about the classical variable sampling, right?
Yeah.
I have a little bit confusing about that project misstatement.
So which one?
I can share you. I can share you with my. Oh, host. Oh, you can't let me share you. Oh,
Let me see if I can see advanced. Hold on a second. Hey, there's a way I can let you share it. Hold on. Okay, let me see. So yeah, see if you can share the document with you. You might be able to put it on the screen if you want. I take a look at it.
basic.
Or if you want, you can show it to me later. You can email it to me or something too if you don't want to put it on the screen.
Oh, maybe I can't find it now. Okay, I just ask you like this. Last time we talk about that mean per unit.
Yeah.
Example. Yeah, I have a little bit of confusion about like a project misstatement, right?
Mhm.
That's a project misstatement means audit value minus the population value, right?
Right.
Okay.
Yeah. And again, the mean per unit is kind of a funny one because the mean per unit is when you don't take any of the client's information, you just use your own. And so,
Oh.
yeah, it's very possible you come up with an overstatement or an understatement where the other ones, the overstatements and understatements don't match.
It means that I find the audit value and what's how to calculate the project misstatement?
The rejected misstatement will just be the average audit times the total number of items in the population. So, here.
Or means sample.
Which number is it that you're looking at? I can pull it up. By the way, the rest of you, if you don't have any questions, you're free to go. But let's see if I can pull up the here classical sampling. Okay. So which one is it?
I just confused about that mean per unit means like something like a project misstatement.
Yeah. So like
Oh yes.
Let me do one of these. So first, like this one, number 4.
Yeah. You can do this one too. Yeah.
Okay, so this is the so the total number of accounts receivable is 100,000. We have a sample of 1,000, so the book value. Actually, we just need the audit value for this one. So we take this, we divide it by the 1,000 items in the sample.
Yeah.
And that gives us an average of what, $64? No idea.
Yeah, 64.
Is the average per audit. So we come down here to the mean per unit. What we say is that oops, something wrong here. Is that we say that look, everything is, this is our average per audit. We're saying that everything should be this average. So we're going to take all of these. And say, okay, each one of those should be worth $64.
So this is a project value, right?
Yeah, so this is this is the projected. So it's to be 6,400,000. So this would be the projected value. I should label that. I know what I can do. I'll move it over a little. So this will be the projected value. So we're saying that,
The project misstatement, I confused you about this one.
okay, yeah, so this is the projected value, so this would be up here.
Mhm.
I don't know where that is. And so you go, okay, well, so this is what we think the value of the accounts receivable is. We think the accounts receivable value is 6,400,000. Now they have accounts receivable as being 600,000. So the question is,
Yeah,
are they over? You know, what's the misstatement? And then are they overstated or understated?
I think it's 400,000. That's is that correct?
No,
No.
400,000 is correct. Yep. So the 400,000, the extra 400,000 is. At, now here's the question though: is it overstated or? Yeah, let's get 0. Is it overstated or is it understated?
Oh, this is under.
Yes. Yeah, we're saying it should be 6,400,000, so this would be understated.
Okay, I understand. Just the project value minus the book value is the missed statement.
Yeah, and that's, you know, one of the problems of this one is the mean per unit is that it ignores, you know, the book value, doesn't use it at all.
Oh, okay.
And again, yeah. So it's in that way it's a little bit well, it's useful. It's used for things that are about the same, you know, that are usually about the same value. If everything is close to the same value, it's not a bad one to use. It's also, you can use it when you don't have a book value. I don't know when that would ever be, but if you don't have a book value, you can also use this one to come up with a book value. Again, it would be hard to imagine a company not having a book value for something, but if that were the case, or if there was some kind of you know, if they had some kind of loss of records or something, I guess you could also use this method. But yeah, so it's a little bit different of a method, but it'll give you projected misstatement. And this is one of those ones that could be used for almost anything. You can use this to measure the weight of antelope somewhere. You know, I mean, you could use it for almost anything.
Besides turning in the test you're going to give us, did you want one of our other sets of notes, or did you want the what do you call it, that multiple choice test, or what else do you want us to turn in?
Question. Yeah. Turn in the multiple choice one. I'll put a drop for that in. I will do that shortly. Let me write it down.
And then we'll hang on to the sampling overview until we finish it. Is that?
Yeah. Do not turn in. Yeah, I won't put anything for the sampling review, but the multiple choice one I'll put on as a assignment. And
then we're going to have the test that you're going to send out.
Yeah, and you don't need to turn back in the chapter 5 with the confirmations and the bank stuff. You know, we covered it. It'll be, you have the knowledge. So yeah. So don't turn, you don't need to turn the chapter 5 back in. There's no reason to. Okay. And I should get those graded shortly too. I didn't look at them this week. Any other questions? Okay, well, if you guys have any other questions, you email me. My office hours, I changed them to all Friday. I didn't, because there's some people that wanted evening hours, and I can't do evening hours because I Monday through Thursday, because I teach class at that time. So anyway, so on Friday noon and at 6 o'clock I have office hours. But you can also contact me anytime. You know, if those hours don't work for you, or if you prefer doing it at a different time, let me know, and I can usually, if I'm not teaching, it can I can do Zoom meetings or whatever. So anyway, I do have office hours out there for noon and 6 p.m. on Friday. But again, if if you want to have other office hours, just instead of a separate Zoom meeting, just let me know. Okay, so I will post the multiple choice assignment. I'll also post the exam. Those will both be due next week, and the exam should be sent out either tonight or tomorrow. Any questions? Okay, well, I will see you next week. All right, and we'll finish. We're definitely going to finish this the sampling overview. We'll start out with that next week.
Thank you.
Chapter.
Thank you.
All right. Good night.
Bye.